remains in the red. Aadil Zaman is partner at Wall Street Alliance Group, and he joins us now in the studio to talk a little bit with us about how people are viewing investing in stocks right now, given that things feel overextended, especially when it comes to those big tech names. And we see that with the extreme reaction to Broadcom's disappointing outlook. How are people talking to you about their exposure and what kind of exposure they want to tech?
So as far as tech is concerned, we think that that's basically the phase one. That's what we are calling the AI winners. And we think that those companies did benefit a lot. But right now, what we're also seeing is that if you look at the Mag 7, they're actually underperforming. If you compare the NASDAQ returns and Mag 7 returns up until Tuesday's close, it's less than 50% of the return of the NASDAQ, right? So what we are talking to clients about is just even within tech, you have to be broad. You have to improve your breadth. And the other thing that is very important right now, extremely important, is right-sizing your positions. Because if a stock is up like 500-600%, it's very easy to get 15-20% of your portfolio invested in that. So make sure that you're booking some profits. Make sure that you're right-sizing your positions. That's how we are framing it with our clients.
How are you framing the AI story? Because I think maybe 3 years ago when we first started really hearing about this, and we got some crazy CapEx numbers, and we got some crazy numbers out of NVIDIA. It's gone from just buying the chips, which is still a great strategy, as you see with the stock in the
stocks in your mind.
I think we've identified 3 phases of AI, which is phase one is the AI winners, which is, as you said, the chips, the hyperscalers. Phase 2 is that where's all this CapEx spending going to go to, right? This $800 billion that the hyperscalers are going to spend this year, who's going to receive it? There we are talking about the AI enablers, which are the brick and mortar companies that are building the infrastructure for AI. So think utilities, think construction, think industrials. And then the third phase is AI beneficiaries, which are companies that are now actually implementing AI into their businesses and seeing some cost savings there, seeing some meaningful productivity increase. I think a lot of times what we are seeing is that people are just focused on phase one and neglecting phase 2 and phase 3. So we are advocating to clients, we are working with clients that making sure that the exposure is there across all phases of AI, not just the first phase, which is easy to miss.
And of course, at some point, you want to have something other than tech in all its different forms. You want to get to industries that are also in the news. I think about energy, for instance, or utilities. They might be adjacent to tech, but they're not in the white hot spotlight.
Absolutely, and it's a lot about diversification. So for example, if you look at the market today, some of the sectors that are up are sectors like energy, right? So it sort of balances it out. And I think that diversification, making sure you're into utilities, making sure you're into energy, not just focused and hyper-concentrated in tech, is really the key.
Yeah, energy, by the way, the best performers of the year, up 29%, almost 30%, whereas the tech index, sub-index, is up about 24%. What about international? Are people still obsessed with the U.S. and kind of overlooking what opportunities might exist outside the U.S.?
I think so. I think it's an under-owned sector right now, international. So it's very important to, and what, from a cyclical point of view, it works as well, right? So when the tech bubble burst, for nearly a decade, international outperformed. And we are coming out of a 14-year cycle where US has outperformed, and I think that cycle is now changing, starting from last year, going into this year. There are much better valuations available. There's much better breadth available in the international markets. So we do really like international here.
Yeah, Paul, I'm looking at the Nikkei up 34% year to date versus the S&P's 10% or the Nasdaq's 11%.
Yep, absolutely. How's market sentiment out there? It seems when we get a lot of these big new IPOs, it signals this market's in good shape and companies are rushing to raise capital. How do you view investor sentiment out there?
There are 2 schools that we are seeing. We are seeing some clients that are cautious and that realize that at some point there could be some type of volatility or pullback in the market. There's one set of clients that have a little bit of FOMO, right? They have this fear of missing out and they don't want to miss out on the latest technology. They want to be invested. So our job as advisors is to help them balance it out. Because at the end of the day, AI is here to stay. Economy is doing well, right? So you want to stay invested, but you want to invest in it the right way. And that's where we are guiding people.
How does fixed income fit into your portfolio? We have seen treasuries not really serve as the safe haven that many people had expected. And there's obviously a lot of big concerns about structural issues with our fiscal spending.
Sure, yeah. I think that for us, the way we have always viewed fixed income is from an asset allocation point of view, just a diversification. And for clients, a lot of our clients are physicians that are, in their 60s, and they want safety. And for them, high quality fixed income is a key part of their portfolio. We tend to do about 20 to 30% in fixed income, just as a balance out of their portfolio.
On the flip side of that, how about alternatives? Because I've been surprised at how many advisors, or the allocation that advisors are putting clients into alternatives. How do you guys think about that?
Yeah, I think sometimes advisors go overboard with alternatives, right? And we tend to be a little bit more cautious there. What we do like a lot is gold. I think that serves as a natural hedge in the portfolio, right? Whenever there's geopolitical tensions, gold tends to do well. If you feel that the dollar is going to become weaker, gold tends to do well, right? And last year was a classic example where we could optimize the risk-adjusted returns for our clients by having exposure to gold. Some portfolios we had 3%, some portfolios we had 5%. It went up more than 60% last year. So we are playing the alternative that way.
Anyone asking about private credit and private equity? I mean, there's been the golden age of private credit was 2023 to 2024. We're definitely seeing some cracks in the foundation now. And you now have Blackstone limiting redemptions from one of its funds. So we're seeing this happen quarter after quarter. Are people seeing opportunity there, or is this something that they want to steer clear of?
I think it hasn't. We deal with a lot of physicians, a lot of retail clients. It hasn't caught their attention as yet.
Really? There's, I mean, the industry is doing a hard sell.
Then, yeah, in the sense that the fear of private credit, right? That fear hasn't caught on to them.
I see.
That's what I meant. So that hasn't caught on to them as yet. So
yeah. They're staying. They're not ruffled.
They're not ruffled by that. Yes. So
are your clients saying, I want to get in on this SpaceX IPO. I want to own Anthropic and trying to scrounge up some shares for me? Are you getting reverse flow interest?
Of course. Yeah. That's always, like whenever there's these type of sexy stories, people always want a piece of it, right? But so we talk to our clients. We remind them what happened with Meta, if you remember.
Yep.
Came out with the IPO, shot up, then shot down, and that was the best entry point. So we sort of, we understand that these, especially in the case of Anthropic, really good company, but you have to be careful about valuations and you have to look into piecing into these type of positions. So that's how we are guiding them.
Is this something that people are going to try to get into? It'll be difficult to, especially in a case like SpaceX, which is not making a lot of shares available, but it will be included in indexes eventually. So without much of a choice, people will be exposed to it anyway.
Sure. Yeah, that's true, and that's why these positions could potentially continue to go higher in the long term because their indexes will have to take part in them as well.
How do you guys utilize ETFs? That's been such a growth story on global Wall Street over the last decade or so. How do you guys use them?
So we use them in our portfolios in a way that it helps us diversify, right? Especially in certain sectors. So for example, we like Mexico as an example. Why do we like Mexico? Because their relative tariff rates are very low, so their exports to the US are increasing. We like Japan as well because we think that that's a great way to get exposure to developed markets. For those two, we do the iShares ETF, right? And we get exposure that way. So whenever we want some specific exposure where we think it's safer to go with the ETF, we put it into the portfolio and overall make sure that our asset allocation is on point.
So it sounds like for exposure, you go to ETFs for beta, but you're not necessarily doing it for alpha.
Correct.
Awesome. All right,
Taking
Aadil, thanks so
advantage
much.
of those low fees.
Yep, exactly right. Aadil, thanks so much. We appreciate it. Aadil Zaman, partner at Wall Street Alliance Group here in our Bloomberg Interactive Broker Studio.